Good evening, everyone. My name is Dr. Tisa Silver Kennedy. I'm the founder and director of the Maryland Center for Collegiate Financial Wellness, and I would like to welcome you to the May 25th edition of Office Hours. Let's take a look at the agenda for this evening's session. First, I'd like to talk to you a bit about the Maryland Center for Collegiate Financial Wellness, then specifically about this event, Office Hours. From there, we'll jump right into questions from our community, and many of them have centered around graduation and the class of 2022, preparing for loan repayment, and also public service loan forgiveness, especially the Limited PSLF Waiver, because it's a limited time opportunity that's set to expire in just over 5 months. And I'll also reserve some time at the end of this evening's sessions for additional questions and answers. If you have any questions, please do drop them in the chat if you're joining me on Zoom tonight, or leave a comment under the Facebook Live broadcast as we have gone live. Just verifying that we have gone live. All right, so let's go ahead and just let me give you a brief introduction to the Maryland Center for Collegiate Financial Wellness, which we call MCFEW. We are building financial life skills and empowering students to thrive. Our vision is for all college and career school students in Maryland to achieve these 6 pillars of financial wellness, which are 1, being creditworthy, 2, being ready, 3, being resilient, 4th, being empowered, 5th, being successful, and 6th, being thriving. And I want to pause just a moment to talk about that 6th one, thriving, and explain it in detail. We want students to complete their collegiate experience, prepare to set and achieve personal financial goals that are in line with their individual preferences, circumstances, and priorities. So much of money is very personal. And so it's our goal to equip students with financial life skills that can truly empower them, not just to get by, but to thrive. And for students who've had to borrow loans to pay for their higher education experience, that loan repayment can often be a drag or a drain on their ability to thrive. So that's why we are providing Office Hours, this free venue, to provide support, especially for Marylanders as they're navigating student loan repayment. So that brings me to this, Office Hours. Office Hours is a free semi-monthly virtual student loan clinic that provides borrowers with a trusted venue to help them navigate student loans and prepare for financial success beyond repayment. I must say that prior to founding the Maryland Center for Collegiate Financial Wellness, I've had my own company for about 4 years, but also worked in financial education and wellness at a graduate professional institution in Maryland. It was my responsibility to provide graduates with advice on student loan repayment. And since accepting that role, I have advised students and families personally on the repayment of more than $75 million in student loans. So it's really my pleasure to be here and able to provide that type of information to Marylanders through Office Hours. I will add this disclaimer before we get into the questions from our community, and that's that Office Hours is for informational purposes only and should not be construed as financial or legal advice. I do my best to find the most up-to-date information from the most reliable sources, primarily the U.S. Department of Education's Office of Federal Student Aid, but ultimately, as the borrower, you have to look at your financial situation and make a decision that works best for you. So take in resources from reliable sources, such as the Maryland Center for Collegiate Financial Wellness, and of course, the Department of Education. And if you have any private loans, of course, you want to include those lenders in your mix of information as well. But look at all of that information, look at your cash flows, and then make the decision that you feel is most appropriate for your personal situation. All right. So much of the talk since we launched Office Hours in December has been around public service loan forgiveness, particularly the Limited PSLF Waiver, which is a time-sensitive opportunity that can bring public servants closer to realizing federal student loan forgiveness. We're going to spend some time this evening talking about public service loan forgiveness under the original rules, as well as PSLF through the limited waiver. But I just wanted to share with you at the start of this evening's session that we are embarking on a statewide awareness campaign to reach public servants across the state. That's people who work for the government, whether that's federal, state, city, local, or tribal, 501c3 not-for-profit organizations, and other qualifying nonprofit organizations that provide qualifying services. We want everyone in Maryland to know about public service loan forgiveness and the limited PSLF waiver so that they can take advantage of this opportunity to get closer to having their remaining debt canceled tax-free after they have met the requirements of the program. So that campaign is called MD TAPS, and MD TAPS stands for Maryland Tell a Public Servant. So if you know of a public servant who has federal student loans, I encourage you to share with them the resources created by the Maryland Center for Collegiate Financial Wellness. We have a webpage dedicated to public service loan forgiveness, and you can visit us online at mccfw.org/MDTAPS. There you'll find information about eligibility, as well as how to apply for public service loan forgiveness, and making sure that if you are a public servant with federal student loans, that you apply through the limited PSLF waiver before October 31st of 2022, because that's when the waiver expires. So more about 2022, it is a time of celebration for many people who have completed their higher education journey. So I just wanted to take a moment to say to the class of 2022, congratulations. Happy graduation to you. I am extremely proud of your achievements, and I just wish you the best going forward. And I hope that you're able to take some time and truly reflect on the importance of your completion, whether that's an associate's degree, bachelor's degree, a graduate professional degree, or certificate or trade program. It's a big deal to finish. So congratulations to you on finishing what you started, and I wish you much success in your next endeavors. For many people, the higher education experience involved borrowing student loans. So I'm going to start off this evening's Q&A with a question that we received about loan types, because it's easy to lose sight of certain loans if they're not all from the same lender. So we had a really good question come through from someone in the class of 2022. And that question is, I thought I had private loans, but now I don't know. How can I tell if they are federal? So this person is wondering if their loans are federal student loans or private student loans. Let's talk briefly about the difference between federal student loans and private student loans. Federal student loans are loans that are issued by the federal government. So the U.S. Department of Education is the lender for federal student loans. Private loans, on the other hand, are issued by external entities outside of the federal government. So this would come from banks, credit unions. Any lender that's outside of the federal government is a private lender. So to find information about your federal student loans, you can log into studentaid.gov. There's a dashboard there that has your aid history that will include grants as well as loans. So if you have any federal student loans that you borrowed, they will be visible on studentaid.gov. You'll just need to log in with your credentials and view your loans. And anything that you see in there will be a federal loan. Some examples of federal student loans are direct loans. Those could be direct subsidized loans, direct unsubsidized loans, direct plus loans for graduate students, or direct plus loans taken out by parents. You might have also heard the loans referred to as Stafford loans, or Perkins loans, or plus loans, but those are examples of federal student loans. If you need to locate private student loans, then the lender is the best place to go for information about that particular loan and making repayment arrangements. If you're unable to remember the lender or lenders, then you should pull a copy of your credit report, and your credit report should include all of your private loans as well as your federal student loans. So if you're wondering if a particular loan is federal or private, if you see it when you log into studentaid.gov, that means that the loan is federal. If you do not see the loan on federal on studentaid.gov, but you do see other loans in your credit report, then those other loans would not be considered federal loans. Either way, your credit report should contain all of the student loans that you've borrowed. You can also reach out to your school's financial aid office. They can pull the history of your borrowing for you. So let's talk more about the class of 2022 and what's next, specifically when it comes to student loans. So this is a unique year in the world of student loans, to say the least. So it's not, this is not the typical information that I give to graduates when they're just, collecting their credentials and getting ready to head toward repayment. So we have been in what's called the CARES Act forbearance since March of 2020. And with that forbearance, most federal student loan borrowers have not had to make a payment since March of 2020, and also have benefited from a pause in interest. So interest has not accrued since March of 2020. The return to repayment date has been postponed several times. Most recently, it was postponed from May 1st of this year to August 31st of this year. So right now, as far as I know, repayment is expected to resume after August 31st of 2022. So if you are a student that just graduated, and this is your first time graduating or separating from your institution, then what happens next is called the grace period. So if you just graduated, you've entered the grace period. It's a period that usually lasts for 6 months. And during that time, payments are not required. This is the time when you're expected, I guess, to basically be getting your life together. You're finding employment, you are securing housing, you're making plans for the future. So during that 6-month period, you are not expected to make a payment on your federal student loans, provided that you have not exhausted that grace period already. So immediately after graduation or separation from an institution or dropping below half-time credits, the grace period goes into effect, usually for 6 months. After the grace period ends, you'll be expected to begin making payments. As for when repayment ends, this is one of those things that is personal. It truly depends. There's several repayment plans available on federal student loans, and we're going to go through those to see what they look like. And they have terms attached to them, ranging from 10 up to 30 years. But truly, repayment is over for you when your balance equals 0. And although those plans have set terms, you can do things to speed up the process, or sometimes extend it if you experience financial hardship. So we'll talk more about what repayment really looks like on a personal level. So one of the biggest choices that you'll have to make is choosing a repayment plan. And there are 2 varieties of payment plans: income-driven plans and balance-driven plans. I'm actually going to begin by explaining balance-driven plans because they're easier. Balance-driven plans operate in the way that the name sounds. They're based on the balance of your loans. So when it comes time to calculate the payment for a loan using a balance-driven plan, it's just a matter of the amount you borrowed and the amount of time you'd like to take in repaying that loan. So the amount of your loan is the primary driver, but there are different varieties of plans with varying repayment term lengths. So the terms are usually 10 or 25 years. But if you consolidate your loans, consolidation loans may offer a 30-year repayment term. So again, with the balance-driven plans, it's about how much you borrowed overall and selecting which repayment term you're comfortable with, the 10, the 25, or the 30 if you consolidated. Income-driven plans, on the other hand, are a bit more complex. They're not based on the overall amount that you borrowed. They're based on household characteristics, including your family size, your tax filing status, and your adjusted gross income. Because income-driven plans are based on these household characteristics and not just the amount of money you borrowed, the length of the repayment term may vary. 20 or 25 years are the typical lengths that are out there. But again, it can vary depending on your income and how your income changes over time. And speaking of the fact that income can change over time, income-driven plans require borrowers to recertify those household figures periodically. Typically every 12 months, you will have to provide answers for the same questions: family size, tax filing status, adjusted gross income, state of residence is also included. But those answers are used to calculate a monthly payment that's good for the next 12 months. And once you recertify and answer those questions, the payment resets for the next 12 months. If you experience any type of financial hardship, such as loss of income or loss of your employment, then you can contact your loan servicer to give them updated information, and they can let you know of your options, whether it's putting those loans into a deferment or forbearance, or if it's recalculating the income-driven repayment amount. But just contact your servicer if you experience any hardship, and they can rerun those figures for you and revise your payment. But the big thing to take away here is that these are the two varieties of repayment plans. One in which you can pay based on the amount that you borrowed, the other which allows for more flexibility for you to pay based on your household characteristics. So let's take a look at some of those income-driven repayment plans. With income-driven repayment plans, the monthly payments are based on a borrower's income as well as other related factors. Income-driven repayment plans also have a feature that offers cancellation after the borrower has made monthly payments for at least 20 years. That cancellation period could be 20 years or 25 years, depending on the borrower and the kind of education that the borrower received. So I've listed for you here the types of income-driven repayment plans. One of the older ones is income-based repayment. We usually refer to that as IBR. IBR offers cancellation after a borrower has made payments for 25 years. Those are for people who are not considered to be new borrowers. And for those new borrowers who borrowed after July 2014, the cancellation period is 20 years. So in theory, if you were to enroll in an income-based repayment plan, make your payments on time in full as promised, and you were a new borrower, you did that for 20 years, in theory, the balance of your debt should be forgiven after you have made those 20 years worth of payments. In reality, it hasn't worked out that way. The Department of Education is currently conducting a one-time review of the accounts for borrowers who have been paying under those income-driven repayment plans to give them credit toward that 20 or 25 year mark so that people can begin to receive the cancellation that they were supposed to receive. So keep in mind that what I'm sharing with you here is in theory, and in practice, it hasn't worked out that way, but the Department of Education is taking several steps to address that right now. So that's income-based repayment. The next income-driven repayment plan is called income contingent repayment, or ICR. ICR is a repayment plan that is one that is used by parents who are interested in public service loan forgiveness. We'll dig into that a little bit later, but most people who borrow student loans for themselves are not paying under ICR. Either way, ICR offers cancellation after a borrower has made payments for 25 years. Some of the newer plans are pay-as-you-earn and revised pay-as-you-earn. With pay-as-you-earn, cancellation of the remaining debt is offered after a borrower has made payments for 20 years. With revised pay-as-you-earn, there's a difference between how loans are treated depending on if the education was for an undergraduate degree or a graduate degree. So with revised pay-as-you-earn, which we refer to as REPAYE, undergraduate loans are offered cancellation after the borrower has made payments for 20 years. For graduate school loans, cancellation is offered after the borrower has made payments for 25 years. So key thing again to remember about income-driven repayment plans is that they offer flexibility because they are based on the borrower's household characteristics, and they also offer cancellation after the borrower has made payments for a minimum of 20 years. It's also possible with the income-driven repayment plans that a borrower's income is so low that their required payment could be zero. So again, lots of flexibility there with the income-driven plans. The balance-driven plans, not so much, because those are based on the amount that the person borrowed, not their household characteristics. So let's move on to talk a little bit about the choice of repayment plans. So I've got an example here of Christina, who has $30,000 in student loan debt and $31,500 for her adjusted gross income. Her payment, monthly payment, ranges from $103 to $311 per month. And these estimates were obtained using studentaid.gov's loan simulator. You can use the loan simulator by visiting studentaid.gov, logging in so that your actual loans can be used to review estimates for what repayment might look like for you. Now, this is a lot, okay? But what you're looking at, these are the choices, or some of the choices that federal student loan borrowers have when it comes to deciding which repayment plan they'll pick. So for those of you who think that the repayment plan decision is an easy one, I'm telling you, it's not. For people who have a relatively low amount of debt, it can be easier because their options are fewer, but this can get very complicated depending on the balance that the borrower owes, where they're working, relationship status, number of dependents. It can get very complex. So it's important for you, the class of 2022, to get started with repayment on the right footing so that you know your options and you can pick the plan that is most feasible for you and your household finances. So let's walk through these plans one by one. The standard plan. The standard plan is a balance-driven plan. This is a plan that has a repayment term of 10 years, and it's a fixed payment. So the borrower is expected to pay the same amount every month for 10 years. And at the end of that 10 years, their balance remaining will be zero. So in this case for Christina, on $30,000 worth of debt, her monthly payment is estimated as $311 per month. And after paying that on time in full for 10 years, Christina will have no balance left and will have repaid a total of a bit more than $37,000. The next plan you see listed is another 10-year plan. It's called the graduated repayment plan. It's a 10-year plan, but the difference between the graduated plan and the standard plan is that the graduated plan starts low and ends high. So in this case, Christina's payment for the first 2 years would be $175. After those first 2 years, her payment would rise for the third and fourth year. It would rise again for the fifth and sixth year, and so on. So the payment in the first year is $175, which is much more affordable than the $311 plan. $311 payment is offered by the standard plan. But by that 10th year, Christina's monthly payment is expected to be $526. That's a lot more than the $311 offered by the standard plan. So the debt would still be repaid over the course of 10 years, but as a result of starting with lower payments and ending with higher payments, Christina would end up paying more interest overall, almost $2,000 worth of additional interest, because when you pay lower amounts, especially early on, there's less money going toward the principal balance of the loans. There's more money going toward the interest, and paying toward the interest doesn't cause the principal balance to go down. So in this case, by taking 10 years, but starting with low payments and ending with a high payment, Christina still repays less than $40,000, but she ends up paying almost $2,000 in extra interest by going with the graduated plan instead of the standard plan. Now, the next two plans that you see are also balance-driven plans, but the term length is much longer. We're looking at plans that have 25 years for the loans to be repaid. The extended plan is a fixed payment, which means Christina would pay the exact same amount every month for 25 years. that amount will be $167. So after making 300 payments of $167, Christina's debt would be reduced to zero, but overall she would have repaid more than $50,000 on a $30,000 balance. So what you're seeing here is, again, the result of making those lower payments, and most of those payments going toward interest as opposed to principal. And since the principal is remaining there longer, it's out there, instead of 10 years, it's out there for 25 years, that means that there's going to be, it's going to take a longer time to pay off that debt. So in this case, Christina would pay $50,178 over the course of 25 years. And remember that $50,000 to be repaid is after borrowing an original $30,000. So when the repayment term stretches out, it's very easy to see how these balances can swell. Now, the next plan is also a 25-year plan. It's the extended graduated plan. This is a plan that, again, takes 25 years, but it starts low and ends high. So in this situation, Christina's payment for the first couple of years is expected to be $113 per month. And every 2 years, that payment would rise, and it would repeatedly rise until her last year, that 25th year, the payment is expected to be $284 per month. With this particular plan, if Christina makes all those payments on time in full, at the end of 25 years, she will have repaid almost $55,000 on a $30,000 original balance. The difference, again, is interest. When you make lower payments, there's less money available to go toward paying down the principal on the loan. And stretching that repayment term out to 25 years results in extra interest paid. So almost $55,000 if she repays by way of the extended graduated plan. For this reason, I typically advise people not to pay under the extended graduated plan if they can afford to pay a bit more. You also have the option to pay extra each month. So if you were to enroll in the extended graduated plan, you just have to meet the minimum each month. So if in those first 2 years, $113 is the minimum, maybe you can send $120, and the extra $7 each month will help you attack more of that interest and hopefully get to the principal earlier, and could shave off some of the overall interest to be paid over time. So again, very personal choice. The extended graduated plan might be the one that's most feasible for some people. And if that's the case, perfectly fine. Just keep in mind that by stretching the repayment term out for so long and making lower payments, especially in the earliest phases of repayment, that's going to cause extra interest to accrue. So those first 4 plans that I just went through are all balance-driven plans based solely upon the amount that the borrower has taken out and their preferred repayment term, 10 or 25 years. The last 2 plans that you see there are income-driven plans, pay-as-you-earn and revised pay-as-you-earn. So with pay-as-you-earn and revised pay-as-you-earn, the formula is the same. So you'll see there that Christina's monthly payment in her first year is expected to be $103. The payment is $103 because it's based on her adjusted gross income of $31,500. And in this example, I believe I used Christina as a single adult, no dependents. So just based on that income of $31,500, she's expected to be able to afford a monthly payment of $103. With income-driven plans, the plans have to be recertified every 12 months. So Christina would have to, again, provide answers to those questions, which your family size, tax filing status, and adjusted gross income, state of residence, and those figures will be used to recalculate her payment for the next 12 months. So with that first year, that payment of $103 per month, we know that not much of that, I don't know if any of that, would go toward the actual principal balance of the loan. But remember, with the income-driven plans, there's that prospect of cancellation after a person has made payments on time in full for 20 years. So with pay-as-you-earn and revised pay-as-you-earn, with the 20-year repayment term, it's estimated that Christina would repay about $20,826. That's far less than what she would repay with any of the balance-driven plans. And her estimated forgiveness would be $33,177. I have to stress to you here the word estimated, because there is no way for Christina to know right now what she's going to be earning in 15 or 20 years. She also doesn't know what her household situation will look like, if she'll have a spouse or if she'll have dependents. It's just very difficult to predict what your financial future will look like that many years out. So the projection for Christina is that by her last year, her payment will only be $66 per month. And that could turn out to be the case, but it might not, because 20 years is far away. But using her current situation, the loan simulator makes projections about her future, and based on those projections, they'd expect for her to pay back about $21,000 and have $33,000 forgiven. The last case is an income-driven plan, pay and repay, but also in concert with a career in public service, because there is a special program called Public Service Loan Forgiveness that allows for the remaining balance of a borrower's debt to be forgiven after the borrower has worked and made payments, meeting several requirements, but working and made payments for 120 months. So that's 10 years. So if Christina was to enroll in one of those income-driven plans and work in public service for a qualifying employer, she could repay her loans for 10 years, and that amount is estimated at $11,533, and have forgiveness of about $31,028. Again, I stress to you the word estimated, because these are all forward-looking, and there's no way for us today to know what Christina's income and household situation will look like 10 or even 20 years from now. Now, I know this was a lot to give you all these repayment examples, but I just wanted to let you all see that you have options, even within the confines of these repayment terms of 10 years, 25 years, or 30 years. You could pay extra if you wanted to. You can contact your servicer and ask about options for people who are experiencing hardships. There are options for you, and I just wanted to give you an overview of what several of those options look like. If you're interested in knowing what your particular situation would look like, I encourage you to log on to studentaid.gov and use the loan simulator to walk through these different repayment plans to see what looks most feasible for you. All right, at this time, I'm going to take a quick moment to check in on social media and see if I've got any questions. Oh. All right, no questions so far in the chat. So I want to just mention to you very quickly that it's so important to develop a repayment plan of your own, because if you don't, you'll be routed into the standard plan. So if you do not choose a repayment plan for yourself, the standard plan, and in Christina's situation, that was the most expensive monthly payment. The standard plan is the one you will be enrolled in if you do not make a decision about the repayment for yourself. And you should make that decision before the end of the grace period. If you get into difficulty repaying your student loans and you fail to make payments for at least 270 days, that's 9 months, then you'll enter what's called student loan default. And I want you to avoid student loan default if at all possible, because the consequences are severe and far-reaching. And this is a list of the consequences. The first one is that your entire unpaid balance and any interest can become due immediately. This is not realistic. If you can't make a monthly payment, then there's no way that you'd be able to pay your entire balance. But this is one of the consequences of student loan default. Second, you lose eligibility for deferment or forbearance and the ability to choose a repayment plan for yourself. Third, you would lose eligibility for additional federal financial aid. So if you decided that you wanted to go back for additional higher education, you'd have to pay for it out of pocket, because federal financial aid would not be available to you. Also, student loan default would be reported to credit bureaus, damaging your credit rating and affecting your ability to borrow. Next, your tax refunds and federal benefit payments may be withheld, followed up by your wages can be garnished. You can also be subject to legal action and be held responsible for court costs, collections fees, attorney fees, and other costs associated with the collections process. Lastly, your school may withhold your academic transcript. Now, I want to just spend a moment on that particular point, because some people will look at all the rest of the consequences and say, well, withholding my transcript isn't that big of a deal because look at the rest of this. But it can be a big deal, because if you are applying for a job and an official transcript is required and you can't get your transcript to prove that you've graduated, then you might not be eligible for that job. So withholding of an academic transcript may sound like it's not that big of a deal, but that can have some far-reaching consequences. So don't underestimate the consequences of having your transcript withheld. If you're in good standing right now, it might be good to order several copies of your official transcript just to have them on file in case you need them quickly, but also in case you end up in student loan default, you want to be able to have those transcripts available to you in case you need them for employment prospects. All right, so on to some more positive things. I want to share with you some resources for borrowers on information, repayment assistance, and benefits. For the federal government, of course, the best place to go for information on student loans is studentaid.gov. There are also several resources available through the Consumer Financial Protection Bureau, and you can visit them online at consumerfinance.gov. The studentaid.gov is also where you'll find plenty of information about public service loan forgiveness. Next level of government I'd like to direct you to is state government. There are some states that have tax credits that are available for student loan borrowers. Here in Maryland, our state does have a student loan debt relief tax credit. The application for that credit, I believe that doesn't come out until July. I will find the exact date and make sure that I share it with everyone at our next edition of Office Hours, but check with your state government, either the department that handles taxes or your higher education governing authority. They both might have information on tax credits for student loan borrowers. Also, there are loan assistance repayment plans, repayment programs available sometimes at the state level. Visit your state's higher education governing authority and you should be able to find information about those programs. The institution you graduated from is also a great resource for information about those loan assistance repayment programs, and a small number of institutions actually have their own loan assistance repayment programs. They might not be heavily advertised, but you want to take a look and see if they're there and see if you qualify. Lastly, I encourage you to look around you at your community. Look to your employer. You can contact someone in HR benefits to see if there are any special options for student loan borrowers, professional associations, and also don't underestimate the power of the news and social media. Check out headlines and hashtags that are looking to provide student loan relief for borrowers who exhibit certain characteristics or meet certain requirements. The key is if you want help, you've got to look for it. And these are some great places to go for that help. All right, so I want to shift gears here and talk about the Public Service Loan Forgiveness Program, because PSLF has been all over the news due to the Limited PSLF Waiver being announced last October. But Public Service Loan Forgiveness has been around for a while. And for the class of 2002, something that you can do is get started with PSLF on the right track so that you're not playing catch up years from now. So I want to zoom in really on public service loan forgiveness now. So according to the Office of Federal Student Aid, I'm going to give you the official definition of public service loan forgiveness. The PSLF program forgives the remaining balance on your direct loans after you've made 120 qualifying monthly payments under a qualifying repayment plan while working full-time for a qualifying employer. That's lots of qualifications. And like I said, it's easier if you start off on the right track, as opposed to trying to play catch up years from now when you find yourself close to making that 120th monthly payment. So how can you get on the right track? Here are 4 steps. The first one is to take a look at your organization. Use their employer identification number to determine whether your employment qualifies for public service loan forgiveness. Without public service employment, PSLF is not a possibility. So you can start off by determining whether your employer is a qualifying employer for the purposes of PSLF. The second thing you need to do is make sure that you enroll in a qualifying repayment plan. We'll review which plans qualify in just a bit, but I can tell you that generally the income-driven repayment plans qualify for public service loan forgiveness. So if you're enrolled in one of those plans, you should be on track. The third thing I'd recommend is once you begin working, submit the PSLF application to begin the process of having your months of payments and work counted toward the 120 that are necessary to achieve public service loan forgiveness. And the fourth step is to submit the PSLF application once every 12 months and or when you change employers. This is recommended but not required. It's helpful to fill out that application like clockwork, because if you find yourself, let's say 9 years into repayment, but you've had 3 different jobs and you didn't submit the PSLF application, you'd have to go back to all 3 of those employers and ask them to verify your employment. Sometimes that can be challenging. So if you fill out the form as you go once every year, then it can be easier for you once you reach that 120th payment to go ahead and file your application for forgiveness. So when you have that employer identification number, great place to start is the PSLF help tool at studentaid.gov/PSLF. You can enter the employer identification number from your W-2, and you'll be able to see the status of your employer within the PSLF Help Tools database. There are 4 results that you might see. One, which is the one we want, is eligible. That means your employer is in the database as an eligible employer for public service loan forgiveness. There's also likely ineligible, ineligible, and no results. If your organization does not show up as eligible, you still might be able to make the case that it is eligible. That'll just require some follow-up actions. So if you would like to complete the PSLF application, I highly recommend using the PSLF help tool, because it can help you reduce errors in completion, and it can also make sure that you answer only the questions that apply to you. If your employer does not show up in that database, you can manually enter the information, print the form, and take it to your employer for verification. But remember, without employment in public service, PSLF is not an option for you. This is a program that's reserved for people who have qualifying employment. And that's not about the actual job you have, it's the type of organization that you work for. So let's move on to talk about public service loan forgiveness in detail and the 5 requirements of PSLF under the original program rules. So I'm going to walk through these pretty quickly and give a shout out to the Office of Federal Student Aid for this graphic. So you've got to have 120 qualifying payments made on direct loans only while enrolled in qualifying repayment plans, while working for a qualifying employer, and when you're applying for and receiving PSLF. And if you have a balance left over at that time, the amount forgiven after your application is approved is not treated as as taxable income at the federal level. So let's step into these requirements one by one. The first requirement is that you have to make a minimum 120 monthly payments. The only payments to qualify are payments that are made after October 1st of 2007. The payments must be made on time, in full. If you make multiple partial payments per month, that's not going to speed up the process. They'll just be counted as one payment. And to be considered on time, all payments must be received within 15 days of the due date. One good thing about this is that the payments do not have to be consecutive. So if you made, let's say, 60 payments and then you took some time off from work, you would not lose credit for the 60 payments that you made while you were working in public service. Once you start working in public service again, the repayment clock for you would pick up at 61, as long as you're working for a qualifying employer and making those payments on time in full as promised. Again, extra payments do not qualify, so you can't make 2 payments a month and cut the time in half. We're looking at a minimum commitment of 120 months. Another good thing I'd like to share with you is about the CARES Act forbearance. For those borrowers who have been working for a qualifying employer and their direct loans were on pause as a part of the CARES Act forbearance, those months of 0 payments since March of 2020 should count toward the 120 that are necessary for PSLF. The second requirement is qualifying loans. PSLF is for direct loans only, and I provided you here with a list of the different types of direct loans. There's an asterisk there next to direct Parent Plus loans because Parent Plus loans are treated a bit differently. And to gain access to public service loan forgiveness, Parent Plus loans actually have to be consolidated into a direct consolidation loan, and that consolidation loan will then become eligible for public service loan forgiveness. Let's take a look at requirement number 3, qualifying repayment plans. Qualifying repayment plans include the income-driven plans as well as the 10-year standard repayment plan. There are also instances in which other plans may qualify if the monthly payment is greater than the payment required by the 10-year standard plan. Generally speaking, your income-driven plans are the ones that are most likely to yield a balance for forgiveness. So if you're looking to have something left over to forgive after having made those 120 monthly payments, for most people, the income-driven plans are most likely to yield that balance. There's an asterisk there next to income contingent repayment plan. And again, this relates to Parent Plus loans. ICR is the only income-driven repayment plan that's available to parents who are repaying Parent Plus loans. So if you have Parent Plus loans, you would need to consolidate them into a direct consolidation loan and then enroll in the income contingent repayment plan to get on track toward having a balance left over for public service loan forgiveness. All right, requirement number 4. This one, again, is so important, qualifying employment, because without qualifying employment, there is no access to PSLF. And where you work matters more than what you do. Your role within an organization does not factor into whether you are eligible for public service loan forgiveness. It's the type of organization that you work for. So government, from federal down to state, local, and tribal, government organizations or government agencies are qualifying employers for public service loan forgiveness. Also, 501c3 not-for-profit organizations and other not-for-profit organizations that provide qualifying services. In order for your employment to qualify, you must meet the definition of full-time. Full-time is the greater of your employer's definition of full-time, or working an average of 30 hours per week. If you have multiple jobs for multiple qualifying employers, and the hours that you work in those several jobs can be combined to meet that 30-hour per week average requirement, then those part-time jobs can be combined to make the full-time definition satisfied. So if you have 2 part-time jobs for 2 qualifying employers, you could combine those hours. And if you meet the 30-hour per week requirement, then you have reached full-time. Quick note here about nonprofit organizations and work in religious instruction, worship services, or proselytizing. Prior to July 1st of 2021, that type of work did not account toward public service loan forgiveness. However, that restriction was eliminated as of July 1st of 2021. So if you're in the clergy, or if you work for a church or place of worship, you don't have to worry about parsing through those hours to see how many were dedicated toward services to the public and how many were about the religious activities. Now, all of those hours, if they're a part of your job responsibility, can count toward PSLF. And the 5th and final requirement is that borrowers are expected to remain working for a public service employer when they submit the application for PSLF and at the time that loan forgiveness is received. So with these 5 qualifications all having to work together for 120 months, plus the time between when the borrower submits the application and when the application is approved, you can imagine that not a lot of people made it through this. So under the original rules, PSLF has had a rejection rate that's hovered at about 98%. The government announced a temporary expanded PSLF program. They counted payments that had been made under an ineligible repayment plan, and unfortunately, that program had a similarly high rejection rate. So in October of 2021, the limited PSLF waiver was announced. And since then, things have changed quite a bit. Prior to the waiver, people were able to apply beginning in late 2017. Between that time and 2021, 16,000 people had been approved for public service loan forgiveness. But after the waiver, between October 2021 and February 2022, 83,000 people had been approved. And as of the end of March, I believe that number had jumped up to 113,000. Don't quote me on that, but I know the number has continued to rise because the waiver has relaxed the rules, and I'll show you how. The slide on the left gives you the original requirements of PSLF. That's 120 monthly payments on direct loans and qualifying repayment plans while working for a qualifying employer and while working for a qualifying employer at the time of applying for and receiving PSLF. In the middle, you have TEPSLF. That only eliminated one requirement, and that's that the borrower had to be enrolled in a qualifying repayment plan. On the right, you see the limited PSLF waiver. You'll see that only 2 requirements remain. The first is that the borrower has to have 120 periods of repayment. So not even monthly payments required, just 120 months when the loans were in a repayment status. The second requirement is that the borrower had to be working for a qualifying employer at the same time. So essentially, the Department of Education and their designated servicer are looking for overlap. They're looking for months where you met 2 requirements. 1, you had loans that were in a repayment status. 2, while you were working for a qualifying employer. And for every month that you meet both of those requirements, those months will count toward the 120 periods of repayment necessary to achieve public service loan forgiveness. Big thing about the waiver is it is temporary. The waiver is set to expire on October 31st of 2022. So these temporary changes apply to student loan borrowers who have direct loans, those who have consolidated into the direct loan program, and those who consolidate into the direct loan program by October 31st of 2022. It's also important to say that for Parent Plus loan borrowers, unfortunately, Parent Plus loans alone are not eligible to receive additional credit under the limited PSLF waiver. So what should you do next? Well, again, the limited waiver is a time-sensitive opportunity. It applies to borrowers who work or have worked directly for qualifying employers after October 1st of 2007. So I'm recommending 3 steps here. The first one is to know your loans. The second is to decide whether you should consolidate. And the third is to certify your employment. To know your loans, you want to visit studentaid.gov and take a look at your loan types. To consolidate, you also want to visit studentaid.gov to complete that application. And the decision of whether to consolidate depends on the types of loans you have. If all of your loans are direct loans, you do not have to consolidate. It might prove beneficial in certain situations, but it's not necessary. If you have FFEL loans, Perkins loans, or other eligible loans that are not direct loans, then you would need to consolidate them to gain credit through the limited waiver. And you'd also need to complete that consolidation by October 31st of 2022. As for certifying your employment, this is something that everyone who's interested in PSLF needs to do, because if you don't certify your employment, the Department of Education and their designated servicer will not know that you are pursuing public service loan forgiveness. So you can do that by downloading the PSLF application in its paper form from studentaid.gov or using the PSLF help tool that's at studentaid.gov/PSLF and submitting the form by October 31st of 2022. So again, for your informational resources, if you are interested in the limited waiver, the Office of Federal Student Aid is the place where you are going to go to process everything. You view your loan types, you can access the PSLF help tool, you can complete the application to consolidate if consolidation is necessary for you. For general information, and especially if you would like to share information about PSLF with the public servants in your life, I encourage you to visit the Maryland Center for Collegiate Financial Wellness at mccfw.org/MDTAPS. And again, MDTAPS stands for Maryland Telepublic Servant. A couple of other resources here, the Institute of Student Loan Advisors. You can visit them online at freestudentloanadvice.org. And for those of you who are truly interested in what borrowers are experiencing when they apply for public service loan forgiveness, I encourage you to visit the Reddit PSLF mega thread that is hosted by the founder of the Institute of Student Loan Advisors. There you can see real-time experiences from borrowers who are applying for PSLF through the waiver and updates as they receive information about the status of their applications. Lastly, the Student Borrower Protection Center at forgivemystudentdebt.org has a step-by-step process there for people to determine if their employment qualifies, view their loans, consolidate if necessary, and apply for PSLF. They walk you through each of those steps and offer advice on making the decision about to consolidate. You can visit them again at forgivemystudentdebt.org. As for Maryland, we are particularly interested in hearing your success stories. We are looking to hear from people, not just those who have had their debts forgiven, but those who have gotten closer to that 120-month milestone that's required for achieving PSLF. So if you have a success story, if you have gained months of credit through the waiver, if you've had your debt forgiven through the waiver, we want to hear from you. Please visit mccfw.org/MDTAPS and fill in that share your success story form so that we can just tell people that the waiver is working and encourage as many people as possible to apply before this waiver expires on October 31st of 2022. I'll just share a couple of victories that we have heard of this month. We've heard from two borrowers, one who had $35,000 forgiven and another who had $96,000 forgiven. Both of these borrowers had been denied for public service loan forgiveness under the program's original rules, but they were able to achieve success by applying through the limited PSLF waiver. One of them reached out in November and received notification of forgiveness very early May. Another began the process in December and just received notice of their loan forgiveness about 10 days ago. So it can take some months, but it's definitely worth pursuing if you work for or have worked for a qualifying employer and you have federal student loans. Right, I have one question that I want to answer before we jump off. I can't believe it's already 7:58, but I want to answer this question because so many people think of the waiver as only beneficial for people who already have 120 months, but that's not true. The waiver can help people with less than 120 months get closer to 120 months. So the question is, I've worked for a qualifying employer, but I don't think I'm anywhere near 120 months of payments. Should I apply for the waiver? And my response is a resounding yes, absolutely yes. So in this example, we have a person, Jen, who's worked for a qualifying employer for 6 years and has been making payments on direct loans under the extended fixed plan for almost 6 years. So she's got 70 months of payments. Under the original rules of PSLF, none of those payments would qualify. She had the right kind of loans, but unfortunately, she was paying on the extended fixed plan. That's the 25-year plan, which does not qualify for public service loan forgiveness. If Jen wanted to get on track for public service loan forgiveness, she would have to enroll in a qualifying repayment plan and then begin making the first of 120 monthly payments. So she'd be starting fresh. Under the limited PSLF waiver, Jen could apply and she could receive credit for those 70 past payments because even though they were made on a payment plan that did not qualify, the waiver has relaxed that requirement. So for Jen, she would go from having 0 months of credit toward having 70 months of credit, meaning that she only has 50 remaining qualifying payments to go before she's eligible for public service loan forgiveness. So if you're in a situation like Jen's, your action steps would be, first, to submit the PSLF application by October 31st of 2022. And second, make sure that you enroll in a qualifying repayment plan so that all future payments would count toward PSLF once the waiver has expired. All right, so last question, how do I know if I qualify? Qualification is determined by your employment and the repayment status history of your loans. So you must certify your employment. That's how the Department of Education and their designated servicer know that you're interested in public service loan forgiveness. And once you've submitted that application, the Department of Education or their designated servicer will evaluate your repayment history. They're looking for months of overlap where you had the qualifying work experience along with the loans that were in a repayment status. And as many months as you have with that overlap, you will get credit for toward the 120 that are necessary for public service loan forgiveness. All right, sorry to have rushed through those last couple of questions, but the time just flew by, at least for me it did. I want to thank you so much for joining me for this evening's May 25th edition of Office Hours. My name is Dr. Tisa Silver-Kennedy, founder and director of the Maryland Center for Collegiate Financial Wellness. And I just thank you for joining me tonight via Zoom and Facebook for this edition of Office Hours. If you're interested in learning more about the center, you can visit us online at mccfw.org. You can also follow us on social media at the McFew. That's at THEMCCFW.